Audit Planning and Fieldwork Part 1. Pre-plan, client's acceptance. Client acceptance and continuance encompasses both deciding on acquiring a new continuation of relationship with any existing one. New client. 1. Communicate with any predecessor auditor. 2. Evaluate the audit firm independence. 3. Ability to service the client's requirements. Continue with an existing client. 1. Similar condition also apply. 2. Additional circumstances determine whether their relationship should be continue. 4. Financial condition and litigation. Continuing clients. Determine reason for not continuing to do the audit. Is there any previous conflicts over scope of the audit, the type of opinion to issue or audit fees? Too much risk exist? Scope of audit work. Engagement letter. The legal relationship between professional firm and its clients. Must be agreed and signed by both parties. Purpose is to help avoid misunderstandings between auditors and clients. Content. The objective of the audit is accordance with auditing standards and other regulations. Responsibilities of clients' management for accounting records and preparation of financial statements to detect of errors and fraud. Responsibilities of auditor to state an opinion on financial statement, and not responsible for detection fraud. Recurring audit. The auditor may send a new letter if any indication that the client misunderstands the objective and scope of audit, any revised or special terms of the engagement, a recent change of senior management, board of directors or ownership, a significant change in the nature and size of the client's business and legal requirement. Fraud is intentional misrepresentation of financial information by one or more individuals among management or employee or third parties, which is manipulation, falsification or alteration of records or documents and misappropriation of asset. Error is mathematical or clerical mistakes in the underlying records and accounting data. Setting audit objectives. Auditors need to obtain evidence that supports each of the assertions for every material component of the financial report. The component financial report may be an account balance, a class of transactions or a disclosure. The categories of assertions provide a framework for developing specific audit objectives. Management's assertions. It is expressed or implied representation regarding the appropriateness of the various elements by the management. Categories of management assertions is existence, rights and obligations, occurrence, completeness, valuation, measurement and presentation and disclosure. The types of assertions may be classified into, firstly, assertions relating to classes of transactions, for example salaries and wages cost. 1. Occurrence. 2. Completeness. 3. Accuracy. 4. Cut-off. Means duration and accounting period. The assertions recorded inappropriate accounting period. 5. Classification. All transaction classified correctly. Secondly, assertions relating to assets, liabilities and equity balances at the period end. For example inventory. 1. Existence. 2. Completeness. Knowledge of client's business and industry. Industry and external environment. Understand. It is about a broad economic business environment. B. The structure and profitability of the industry. C. Technological development. D. Critical issues and significant risks facing the industry. External factors. It is about a competition. B. Social. C. Legal and technological changes. D. And the economic and political environment. Business operations and processes. Factors to understand. I. Sources of revenue. 2. Key customers and suppliers. 3. Source of financing. 4. Information about related parties that may indicate areas of increased client business risk.
Audit planning and fieldwork. Definition of analytical procedure is evaluation of financial information through analysis of plausible relationships among both financial and non-financial. These are the things that need to be included in substantive analytical procedure. The auditor design and perform analytical procedures at the end of the audit that will assist the auditor in overall conclusion. Any fluctuations or relationships that are inconsistent with other relevant information shall be investigated from the following aspects. Next is definition of analytical procedures. As you can see, these are the examples of consideration of comparisons of entities' financial information. The following are the example of consideration of relationship that must be included in analytical procedures. As we moved on, these are what we meant by the definition of materiality. Materiality concepts are made up of these elements. Next, we're gonna talk about the types of materiality. The first type of materiality is overall materiality. The next type of materiality is performance materiality. These are the things that need to be included in performance materiality. Last but not least is specific materiality. By using this method, auditors are able to identify misstatements at lesser than the overall materiality. Auditors can also use quantitative approach. There are several quantitative approaches. Next is about qualitative approach. These are the qualitative factors